If I toss a coin, what are the chances it lands on heads? 50%, right? Simple, predictable, and clear. Now imagine if you could predict your trading success with the same clarity. Sounds impossible? Well, it's not. What if I told you that by understanding just these three simple concepts mean, median, and mode you could gain a real edge in option trading? These aren't just maths term from school. They are powerful tools that help you analyze the market, cut through the noise, and make smarter trading decisions. Statistics might sound boring, but here is the truth. Option trading is not about luck, it's about probability. You don't need to be a math genius or a IIT topper to get this. You just need a curious mind. So let's make this fun and easy to understand. Let's connect this to something which every Indian understands: cricket. Picture Rohit Sharma stepping onto the pitch. Does he swing blindly at every ball, hoping for sixes? Of course not. He studies the bowler, the field placement, the match condition. That's what statistics helps you to do in trading. Analyze, plan, and execute with precision. Let's now break down these three statistical concepts: mean, mode, and median, and let's see how you can use actually these in real life trading. Let's start with mean, also known as average. So example, if you have three numbers, let's say 4, 5, and 6, what is the mean for this? For that, you have to add these three numbers together. 4 plus 5 plus 6 is equal to 15, and then divide it by 3. So the answer is 5, which means that the mean is 5. So in trading, the mean tells us the average stock movement over the time. So for example, if the Nifty moves 1.5% daily on an average over 30 days, you can expect the similar movement unless there is any unexpected event. Now let's look at median. Median is the middle number in the data set. So for example, if you have like 1, 2, 3, 4 and 10 lakh, the mean here would be extremely high due to that one big number, 10 lakh. But the median is 3. Simply, this is unaffected by the extreme. Now, why this is important in trading? Because median helps us to filter out the outliers, the random massive prices swings. This gives you a clear and more realistic view of what actually is happening in the market. Finally, let's talk about mode. The number that appears most frequently. So for example, if you have data set like 1, 2, 2, 4, 8, 10, what is the mode? The mode is 2, which because it's appearing most frequently in this data set. Now, how does it help in trading? The mode tells you the most common price movement. If the stock moves 2% most frequently, then tomorrow's movement is most likely to be 2%. It's like figuring out a bowler's most common delivery and preparing for it. Let's say you are analyzing a 10 days of a stock movement. So here is how these three tools will help you. Mode will tell you that which is the most frequent move. It helps you to feel the rhythm of the market. Medians filter out the big outliers or one-off spikes which to keep the things realistic. And mean gives you the overall trend useful for setting the expectation. So you combine all together and you stop gambling. You start planning the trades like a pro. Remember, successful traders don't rely on luck, they rely on data. They trade like Rohit Sharma, analyzing, planning and executing with precision. And now it's your turn. Let's test our understanding with these 5 quick questions. Question number 1. What does mean in statistics represent? Option A, the most frequent number. Option B, the average set of numbers. Option C, the middle value. Or is it option D, a value that stands out from the rest? The answer is option B, the average set of numbers. Question number 2. why is the median useful in trading? Option A. It helps identify the most frequent price move. Option B. It eliminates the effect of outliers and gives you a more accurate reflection of typical price movement. Option C. It shows the highest price. Or is it option D? It tells the average stock price over the time. The answer is option B. It eliminates the effect of outliers and gives a more accurate reflection of typical price movement. Question number 3. If you have following sequence of stock price move 1%, 2%, 2%, 5%, 10%, what is the mode? Option A 1%, option B 2%, option C 5%, or is it option D 10%? You guessed it correctly. The answer is option B 2%. Question number 4. How can understanding mean, median and mode gives you an edge in option trading? Option A. By predicting the exact future price. Option B. By showing you the overall trend, filtering out rare events and identifying the common patterns. Or is it option C, by guaranteeing profit? Or is it option D, by allowing you to play the market with no risk? The answer is, that's correct, it's option B, by showing you the overall trend, filtering out the rare events and identifying the common patterns. Question number 5. Which of these statistical tools help you to filter out extreme values or one-off events in the dataset? Is it A, mean? Is it B, median? Is it C, mode? Or is it D, standard deviation? The answer is option B, median. Drop your Q score in the comment. I'll personally review and guide you on your next step. If you found this video helpful, share it with someone who is starting out in trading or struggling with data interpretation. In the next video, we will learn the core concept of volatility. Until then, keep learning, keep winning.